Interest rates may sound like a technical topic reserved for economists, but in reality, they influence almost every financial decision we make, from mortgages and credit cards to stock market investments and retirement planning. In today's rapidly shifting economic environment, interest rate decisions are playing a powerful role in reshaping how investors think, act, and position their money for the future. At the center of it all are central banks. Institutions like the Federal Reserve, the European Central Bank, and others around the world adjust interest rates to control inflation and stabilize economic growth. When inflation rises too quickly, central banks often increase interest rates to slow down spending. When the economy weakens, they may lower rates to encourage borrowing and investment. These decisions create ripple effects across global markets. When interest rates rise, borrowing becomes more expensive. Companies face higher costs for financing expansion, consumers pay more for loans, and overall spending tends to slow down. For investors, this environment often leads to a shift in strategy. Growth stocks, especially in technology sectors, tend to suffer because their future earnings are discounted more heavily. In contrast, value stocks and dividend-paying companies often become more attractive. On the other hand, when interest rates are low, money becomes cheaper to borrow. This encourages businesses to expand and consumers to spend, often boosting stock markets. In such environments, investors typically favor growth-oriented assets, including tech stocks and startups. Low rates also push investors to take more risks, as safer investments like bonds offer lower returns. Speaking of bonds, interest rate decisions have a direct and immediate impact on the bond market. When rates rise, existing bond prices fall because newer bonds offer higher yields. This creates challenges for investors holding long-term bonds. As a result, many investors are now shifting toward shorter duration bonds or floating rate instruments to reduce risk. Real estate is another sector deeply affected by interest rates. Higher rates increase mortgage costs, which can slow down housing demand and reduce property prices. Investors in real estate may become more cautious during such periods, focusing on cash flow and stability rather than rapid appreciation. Conversely, lower rates often fuel real estate booms, making property investments more attractive. Interest rate changes are also reshaping portfolio diversification strategies. In the past, the classic 60-40 portfolio, 60% stocks and 40% bonds, was considered a reliable approach. However, in today's environment, where both stocks and bonds can decline simultaneously during rate hikes, investors are increasingly turning to alternative assets like commodities, private equity, and cryptocurrencies to manage uncertainty. At the same time, higher interest rates have made cash more attractive, with savings accounts and short-term instruments offering better returns than before. Global investing is also shifting as differences in interest rates between countries impact currency movements and investment flows. As a result, investors are focusing more on global monetary policies. For individual investors, adapting to this new environment is essential. There is a growing emphasis on quality assets with strong financials and stable cash flows. Additionally, technology and real-time data have made markets more dynamic, with faster reactions to economic changes. Overall, interest rates play a critical role in shaping investment decisions. Understanding them is now essential for protecting wealth and identifying new opportunities in an ever-changing financial landscape.